Hello viewers, I am going to share my views with you on the topic Rupee trapped in the trap of depreciated US dollar. In the midst of depreciated US dollar and appreciated rupee, the rupee has been trapped in the trap of depreciated US dollar, and to save rupee, RBI has tried to control bond market, capital market, exchange market, policy rate, inflation rate, exchange rate, etc. But in the midst of rising physical deficit, rising government borrowings, rising liquidity inflow in Indian economy, rising US bond yields, rising US inflation, out of heavy printing of US dollar by Fed above to 35% of total dollar in circulation, and out of it rupee has been trapped to appreciate in the midst of rising inflow of liquidity. Appreciated rupee puts pressure on domestic market interest rate, where it puts pressure finally on bond yields. Here RBI is trying to regulate bond yield around 5.8% to make it a benchmark interest rate for other interest rates. But RBI has failed to control bond yields on 10-year government bonds around 5.8%, and it has breached and come to touch around 6.1%. Why? The company's bond yields of 10 years have touched around 9% yields, and it all has happened out of huge inflow of liquidity. US bond yields rise of inflation in US market. Here, appreciated rupee makes exchange rate dearer, and exchange rate becomes appreciated one, and appreciated exchange rate makes import cheaper while export dearer, which is highly injurious for Indian economy. And here, out of this import, which becomes cheaper due to rupee appreciation, has invited imported inflation in Indian economy, and out of it, wholesale price index in May 2021 has touched Y13%. This is the situation of appreciated rupee, appreciated exchange rate, and bond yields, and inflow of liquidity in Indian market. Seeing this situation with imported inflation, rising bond yields, and appreciated rupee, international hedgers have entered into Indian economy and has borrowed the cheaper interest rate capital from US market to invest it in dearer interest rate cost capital in India to earn interest rate differentials by carry trade. And in this situation, hedgers have infused or injected a lot of liquidity inflow in the economy. And this has forced rupee appreciation with the pressure of US dollar bond yields, US inflation. This is a situation where international hedgers have imported inflation and other things. On the other hand, with rising international commodity prices, crude oil prices, and other commodity prices, the imported inflation has taken place due to appreciated rupee, due to appreciated exchange rate. This is the situation in Indian economy. And seeing this situation, the RBI has tried to control currency markets and currency manipulators. And for it, RBI has sold US dollar through interbank markets on buyback by paying premium on forward swap. But currency manipulators in currency market have ditched the RBI's strategy, and here currency manipulators in currency market have entered not through interbank market but through non-bank markets, and out of it currency manipulators have earned a lot of profit against appreciated rupee and bond yields rising in US economy, US inflation. This is the situation of appreciated rupee in the context of rising imported inflation, rising bond yields. Thus, here we see that RBI has completely failed to control bond yields, rising bond yields, to control appreciated rupee, to control currency manipulators, or to control currency markets. Because international hedgers as well as currency manipulators in currency markets have become more smarter than RBI and has forced rupee appreciation. This is the trap of rupee, where rupee has been trapped in the trap of depreciated US dollar. This is the situation. In this situation, it becomes clear that RBI has become failure to control rupee appreciation, where rupee has been trapped under US depreciated dollar.